You know, when a company drops its quarterly earnings, it's usually a story about numbers. But Biolargo's latest report, it's like reading two different books at the same time. One is a story of struggle, and the other, a story of immense, world-changing potential. In this explainer, we're going to get right into that central conflict.
So on one side, you have the company's CEO talking about trillion-dollar markets, trillion with a T. But on the other side, reality hits. The day those earnings came out, the stock took an immediate 6.6% nosedive. So what is going on here? Let's unpack this huge disconnect between the company's grand vision and the market's gut reaction.
To really get it, we first have to put ourselves in the market shoes. We need to look at the story the investors saw, the one told in cold, hard data. These are the numbers that, frankly, spooked everybody.
And boom, here it is, the headline number that just screamed sell to a lot of people. A nearly 45% drop in revenue compared to the same quarter last year. Now, this wasn't just a little dip, right? This was a significant miss, and it immediately set off alarm bells for traders.
But you gotta ask, where did this massive drop even come from? Was the whole company falling apart? Well, no. Turns out it was overwhelmingly due to a slowdown in sales of one specific thing, a private label Pet Otterspray. The market just saw that big, scary negative number and tied it to one part of the business hitting a rough patch.
And to really hammer home why investors were so nervous, just look at this chart. It wasn't just that Biolargo's stock was down, it was getting absolutely crushed compared to its peers. The benchmark for similar companies was up over 7%. Biolargo was down more than 27%. So you can kind of see why the market's version of this story is all about skepticism.
Okay, but that's just one side of the coin. Now let's flip it over and look at the second story. This is the company's counter-narrative, the one they believe everyone is missing because, well, you can't find it on a current spreadsheet.
And this quote from the CEO Dennis Kale gets right to the heart of their argument. He's basically saying, hey, if you're judging us on our current pet product sales, you are looking at the wrong thing entirely. The real story, he says, is all about this unseen value they've been building in the background for years.
So what is this unseen value he's talking about? Well, it's not just one thing. They break it down into three huge, potentially game-changing pillars. First, Clyramedical for advanced wound care. Second, the Selenity Battery, aimed at the massive grid-scale energy storage market. And third, PFAS Solutions, a technology designed to clean up those nasty, forever chemicals in our water.
And look, these aren't just pie-in-the-sky ideas. There's real stuff happening here. Clyra already has a distribution network that can tap into over 6,000 U.S. hospitals. Selenity is targeting an energy market that's projected to be worth up to $4 trillion. And their water tech, a unit was just shipped off to New Jersey for validation with the EPA. That's tangible progress.
But of course, a big vision is great, but how do you actually pay for it? Especially when you're a smaller company. How are they going to build all this stuff without needing billions of dollars they just don't have? Well, their answer is pretty clever. It's all about their business model.
They call it a capital-conserving strategy. It's kind of a fancy way of saying they don't pay for the expensive stuff themselves. Instead of trying to raise a ton of money to build factories, Biolargo licenses its technology to partners. Those partners then create joint ventures to go find the funding and do all the heavy lifting. Biolargo just brings the brains. This right here is the perfect way to understand it. Most companies in this space would try to, say, build and sell batteries one by one. Biolargo's strategy is totally different. They want to sell the plans for the entire battery factory. It's a fundamental shift in thinking.
So here's how that selling a factory idea actually plays out. Biolargo provides the tech and manages the construction. Their partner, well, they bring the cash. They're the ones who go out and get the public and private funding. In the end, the partner owns and runs the factory in Biolargo. They get paid for their work up front, and they get royalties and a piece of the company long term. And this isn't just a theory. They've already signed 4 preliminary deals to do exactly this.
So, there you have it. 2 totally different stories. The market is looking at today's weak sales. The company is pointing to this massive unseen potential. So what happens next? Well, the future of this whole saga is going to come down to a few key events, what investors call catalysts.
Here's your cheat sheet for what to watch. By the end of this year, Clyra plans to file its final FDA paperwork. That could lead to a product launch early next year. For the battery tech, the big one is turning those preliminary deals into actual funded contracts. And for the water tech, everyone is waiting on those EPA validation results from Jersey. Each of these is a major test that will tell us which story is closer to the truth.
And that brings us right back to where we started. Is Biolargo this incredible innovation engine that's about to take off, with all this value the market just can't see yet? Or Is it a collection of really high-risk bets that might not pay off, just like the stock chart seems to suggest? The next few months are going to give us the answer and show us which of these two stories was the real one all along.